third show of Futures Edge in the series. I'm Jim Iuorio, and this is a big week to talk about futures. All week long, we've talked about leverage and the evilness of leverage when we talked about Archegos, or however you pronounce that, hedge fund, and what happened in Viacom stock like this. We talk about futures on this show all the time. And futures are attractive to a lot of people because of the leverage they employ. Leverage is not bad. Excessive leverage and misuse of leverage are what's bad. That's what we're going to hammer home on this show very much. I'm a risk mitigator in my DNA. I'm not that huge of a risk taker. And many of you guys have noticed that from a lot of the trades that I've put out so far. They're low risk, high reward if they hit, but not always, they don't always hit very frequently. So we're going to talk about that. We're going to talk about it in a macro way, and then we're going to bring it down to technicals and bring it down to a trade. We have one of my favorite guests who I've been on shows with for a long time, Bill Baruch, president of Blue Line Futures. Bill, good to have you aboard.
Thanks for having me on. Really excited to join you today.
Good. And now Bill is not just a perfect head of hair. I give him a hard time about that all the time. And it stems from jealousy. I do post that picture on Twitter every once in a while of me when I used to have hair and it used to come out like this. And I was quite proud of it. Billy, good to have you aboard.
Thanks.
Look, the stocks. Okay. We saw what I thought was a little bit of a breakout in the NASDAQ today to the upside. Can you speak to that a little bit? First of all, why has NASDAQ been suffering so much since mid-February, and why might that be over now if you think it's over?
Yeah, we've seen a terrific move here today at the end of the quarter. And you know what? Once we've gotten through, just broadly speaking, some of the selling that's come at the end of the last 2 months of this year, January and February, at least the first day of a new month has been really good. So I think we're on track to see some of this, what we have today, the strength carry into tomorrow, and which really is a short week as well. So, but for the NASDAQ in particular, it fell out of favor for, since middle of February, and it's been lagging. A lot of that has to do with the rising interest rates, and the 10-year yield today hit above 1.75%, and as yields move away from basically zero, it forces investors to make a decision. Are you going to invest in that risk-free rate, or are you going to take risk and buy expensive tech stocks? That's one of the narratives out there right now, holding stocks back, holding the NASDAQ back more than anything. But today was a good day, as you said. There was a downtrend breakout, and things are looking very positive for it right now.
Tell me this, when we rallied them up to those highs, that astronomical run we've had from March 23rd back of last year, part of that was just, one of it was the work from home, and the tech names obviously encompass that. And secondly, it was just hide out with companies that had good balance sheets. They've almost become like a safe haven thing. In my opinion, the NASDAQ trailing and the Russell leading for that time was actually a good commentary on where people thought the economy was going. Do you believe in that?
Absolutely. And that's really one of the things that I was hitting home with starting October through much of February, was the rates are going to rise. The reopening trade is going to happen. Vaccines going to begin to roll out. And as we all know, markets price things in very quickly. So all of that happened through the Pfizer news that first Monday in November. Stocks shot up, and that's been the real trade.
Okay, so this is a macroeconomic question. This is not a political question. This is about the virus, the pandemic. When you saw that CDC director come out and talk about impending doom, I repeat, feelings of impending doom. What in the name of God was she talking about? You just mentioned 50% of the people over 65 years old have been vaccinated in this country already. How could she have this feeling of impending doom?
I saw that, and I wrote about that on Tuesday too. It's, it's a tough one to really swallow. I mean, how do you come out and say that? You're supposed to be giving confidence that we're taking steps forward, not taking steps backwards. And look at some of the statistics too. I mean, Texas is open. You can look at the open table statistics. People are out. People want to be out. People want to spend money. That's what's important to this market right now.
So Darden Restaurants, it's funny you mentioned restaurants, and I'm a restaurateur, Brant's of Palatine. That's the shirt right there, Brant's. Darden Restaurants announced last week that the previous week, traffic at Darden Restaurants was above where it was in 2019. That doesn't sound like impending doom to me. It sounds like people were pent up and trying to get out and trying to live again. And that's what I see at my restaurant as well too. Bill, you had a NASDAQ chart. You're trading the NASDAQ. What do you got?
Yeah, we had that top from middle of February, the downtrend that this thing hasn't been able to chew through on several tests, up to about 13,200 and change. Today we broke through that. It's not a clear clear path higher just yet. We still have to get above those previous peaks that the trend line aligned with in the 13,200 change, and we were at the 50-day moving average today. So I don't want to jump the gun too quickly on it and chase today's action. I'm gonna wait for a little bit of pullback, maybe look to buy that right in front of that trend line. 13,050 is where I would want to be a buyer, and some volatility, get a nice fill there. And I would look to trade this. If you have about a $25,000 account per 25 grand, you could risk about 1%. What you're going to do is put 2 micro NASDAQs on and give yourself a nice big stop, 500 points. And 2 micro NASDAQs risking 500 points is going to be a $2,000 risk. Our upside target is going to be a new all-time high in the NASDAQ, 14,050. That's what I think we're going to see here. And you can roll those stops up along the way. That's what I'll be doing.
Tell me this: do you think you said all-time highs? Do you ever use options to hedge? Like, let's say you get a runner, you put on those 2 micros, and you make a lot on right away. Do you ever hedge that with options on the downside or no?
Yeah, absolutely. I think there's definitely a timeline here, and I think this is a really interesting trade right now with the timeline. I think that the rate story is something that's going to be a headwind for tech, but right now I think the path of least resistance is going to be higher on a technical basis, but also as the rates have been digested. So as we see risk on take off in the next 3 weeks is what I'm projecting, towards the end of April, we could really start to see the rate story be a headwind to tech. So one of the ways to really protect and take a larger risk on that trade or a larger contract size would be looking to sell a call up near that 14,000 and then use that money to buy a put to protect yourself too.
No, that's interesting too. Okay, I like that trade a lot. You mentioned the rate story. I've been hearing, for years and years that higher rates adversely affects tech. The story being that a lot of those tech companies, very high leverage, they borrow a lot for growth. Is it true, or just the market just thinks that, and we punish tech when rates are rising? But it doesn't even matter. If the market's going to make that decision, it's going to make that decision, correct?
Yeah, the market right now, it's not so much the rate itself, it's the velocity in which we moved. And going back to October, when I was calling for treasuries to sell off and those rates to rise, my target of the 10-year was only 1.25. But my sort of overshoot was the fact that we're going to see a move of high velocity from 1.25 to 1.5. That's what's going to bring a little bit of a pain threshold. We've really even overshot that. This has gone much farther, more quickly than I thought, and that's why the market's getting hurt. Okay,
so I'm going to give you my spiel on what I think of tens, and then I want you to comment on it too. I think rates are going higher. I think the yield curve is going to steepen, and my trade is going to be something that demonstrates that feeling. I think there's only 2 reasons to buy 10 years. One, the fact that the 20% of the world sovereign debt is trading at negative yield still. I might have that number wrong, but if I do, I don't have it wrong by that much. 2, I think in the back of my head, in the back of everybody else's head, there's this kind of worry that at some point in time, if rates start to go too high, too fast, that Chairman Powell comes out and says something about, just unlimited QE. Now, the only reason I say that is that he hasn't said anything about it yet, but just today, Christine Lagarde kind of threw a veiled threat at bond vigilantes before too. So that seems to be 2 reasons to buy it. And that's, in my opinion, why we haven't shot above 2% already. Because I think when you look at the potential inflationary picture, I would have expected a steeper yield curve. In the end, I think rates are going to creep higher, but I think they're going to do it at a pretty reasonable pace. Does that all sound pretty good to you?
Yeah, absolutely. I think that's exactly what we're looking at, and how that's going to play out.
So if the rest of the world wasn't negative and we didn't have this activist Fed, you think rates could be 2.5% right now, don't you?
Probably. And one of the things too to keep in mind that's with that rate story is we've seen Europe threaten lockdowns for the last couple of weeks and go into lockdowns. And that spread between the US 10 and the German 10 is back to pre-pandemic levels. You know what that means? That's bringing inflows to the US dollar. And the inflows to the US dollar, remember, going back to last year, the US dollar was the sacrificial lamb for the entire global recovery. The dollar strengthens, risk assets are going to have a headwind too. So that's another part of that rising yield story as the US rates outpace the, say, German rates.
Okay, so I'm going to give my 10-year trade now. A trade I do have on, I'm planning on putting on more of these too. I bought the week 2, that's April 9th, 10-year, the 131, 130.5, 130 put fly. I paid 5 ticks for it. You could potentially make a half tick. So you risk $78 to make 422. And one thing you guys may have noticed, these trades we put out, like Bob Iaccino's trades have been absolutely fabulous. And again, these are examples. These are not recommendations. I don't know how deep your pockets are. I don't know what your risk tolerance is. So that's why I stress these are trade examples. Anyway, this trade has a week and a half to go. It's a week from Friday. It targets rates about 1.77, 1.78. I did a rough calculation of where that center point of my fly is. Remember, so that's we're buying a put spread to 131, 130 and a half. And I know, Billy, you know this. I'm telling you, anyone who's watching who might not know, selling the 130 and a half, 130 put spread. So you make your most money at 130 and a half. Again, you're not going to make the full amount on flies. If you are, you're a greater man than me or woman than me. What I plan on doing is hopeful that goes from 5 ticks to 10 or 15 ticks sometimes next week, and I plan on taking it off. Do you like that target, or do you think it's too modest?
Listen, I'm not so bearish on the 10s right here. I think you're right on the fact that it's going to consolidate. It's going to chop around. There's going to be waves of selling. You got Biden unveiling his infrastructure spending bill. So we talks of another bill coming in April that's going to focus on coronavirus relief. As those headlines hit the tape, you're going to get waves of selling in the next 2 weeks, and that really is I think a great trade, because you're going to be able to capitalize on the time decay in the middle part of that butterfly. And on the other part of it, I, as an investment advisor, managing retirement portfolios, I've been terrified to really, start going duration in the 10 years, or like we're buying TLT. We've stuck with short duration corporate bonds in the fixed income side, as well as we just kicked some duration out on the corporate side. But I mean, I am fearful that we could see this thing run. So I think it's a very run lower, and that's something you got to be very careful about as an investor. So I think you're right on this, that just even the chop around is going to make this thing a profitable trade.
So you say it could run lower. You mean prices lower, rates higher, obviously, right?
Yeah.
So it was a Thursday of like 2 weeks ago, and it seemed like there was moments where control was lost in the bond market and even in the Eurodollar market, where it was gapping lower. Do you think that frightened the Fed, and do you think they're going to be more on guard to try to kind of keep it at an orderly pace? Do you think they'll ever do anything?
Well, they've said they're not considering yield curve control right now. And just for those who don't know, that would be selling the shorter end and buying some of the longer end and flattening the curve. But that could be something that they really are holding in their back pocket, just in case something like you mentioned, where this liquidity becomes a little scarce and there's big moves in the market. The other part of it too is they don't seem too concerned right now. I mean, the economy's in a good spot. They did just not extend that exemption on banks counting treasuries in their holdings, the SLR. And so overall, they're not showing concern yet by that, but they do have some other measures in case something would happen that they could step in and do that.
Okay, before I let you go, and we got about a minute and a half with you now. I'm writing a piece for the CME on inflation and perhaps the commodity super cycle. Do you believe, you've seen what's happened in commodities all across the board? Do you think this is something that ranking on a significant scale, from wildly significant to moderately significant, the fact that all these commodities have shot through the roof, if people worried about the dollar and its hegemony going forward?
Listen, I think this commodity super cycle is really just getting started. I think the dollar is going to be lower over the long term. And, there's great shakeouts right now that would allude to this making it tough for people that have held on to things like gold and silver for too long. And even look at crude oil. It's basically $10 from its high. So there's going to be shakeouts like this. I think this is a really good shakeout. If you look at the dollar right now, the dollar index, which is about 57% the euro, so it's really driven by the euro. Dollar index is moving up to some resistance. And on the flip side, the euro, if you look back the chart out, a monthly trend from going back to 2008, it broke out above a downtrend line back in December and November. It's coming back and testing that. Now that's the euro. So that's now going to be support in the 117 area on a monthly basis. We're at the month end right now. So if it goes the trend line would give a little bit more room below 117 on a new month. But overall, I think that the dollar's going to be heading lower. That's going to be powerful for commodities. And another thing to think about too is all that, that inflation, that free money that's out there. I think that's really going to be supportive to things like crude oil and other commodities. You're already seeing agriculture commodities in multi-year highs. And lastly, last part of the kicker is China has been very quiet. They've been actually purchasing sanctioned Iranian crude at this point, but China's been very quiet. You're sort of quiet in their purchases. We're very bullish on crude oil through the summer. We're very bullish on gold and silver at these levels, platinum especially, platinum much more. And I think the agriculture is going to make the next move too.
Cool. I'm going to have to let you go. Billy, thank you so much for being here. It's always good to hear you. It's always good to see your smiling face and your hair, which I love. And I think you're one of the smartest guys around. And thank you very much for being. I'm going to bring Bob Iaccino in now. And we talked about the euro a little bit. And Bobby's going to hit on that a little. Bob, do I got you? Calling Bob Iaccino. Smooth transitions we have here at PureXposure Media Group.
I had to get my hat.
You had to get your hat, of course. How can we even do it without your hat?
That is when I'm anywhere near Bill Baruch.
Oh, good. Oh, we still got him here. Good. I see him. Yeah. Bob Iaccino, of course, you guys all know of the PureXposure Media Group. Bob Iaccino, give the rest of your bio real quick before we get going.
Yeah, so I'm the host of the Market Think Tank, which is another show on the PureXposure Media Group. I'm the co-founder of the PureXposure Media Group, where we have Futures Edge with Jim Iuorio that you're watching right now. But also, I am the co-portfolio manager of the Stock Think Tank, and futures is in my DNA. It's what I came up in. It's where I met Jimmy 26 years ago or so. And
oh gosh,
it was really still the first thing. That
we had great hair back then too, by the way, too. Don't let anybody say any otherwise. And I have photographic evidence to prove it. So we were something.
Yeah, actually, I like to show people the video. There was a video done, a documentary done by Nova called Open Outcry. So if you just Google Nova Open Outcry, the first like 30 seconds of it or so is me without a beard, which is bad. With hair is good. So I always think more hair and cover my face, that's going to make me look my best.
I think that's just called math. I think that's sound planning. You heard Billy and I, we were talking about a few things. But we were mentioning the euro, we were mentioning the dollar, we were mentioning the commodity super cycle. There's a lot of interesting things to talk about, particularly that's dollar related. What can you add to that?
So I like where Billy's going, but I have a different view of what's going to happen in the euro, and it's for similar reasons. I think that the dollar is going to remain the dominant currency for quite some time, because I'm Italian and I've been to Italy and my parents are immigrants and I know how bad they're going to keep doing.
Amen. Yeah.
So from a perspective of Europe, I think the dollar is still going to be the dominant currency for quite some time. Billy likes his trend line at around 117. I've seen that trend line, very long trend line, but I think it's going to break, and I'll tell you why. Trend lines define a trend, but they're not really reliable in terms of taking trades, in my opinion. Now, if it's your fundamental view and the trend line is where you're going to enter the trade, very smart thing to do. I have more of a target in the 115 handle for the euro. And the reason I bring that up is because we've broken the 200-day moving average on the euro. And I want to sell a pop back up to that. Now, it's not like stocks. When you look at the 200-day moving average in stocks, that's generally where people, institutions as well, pile in on the long side, right? Because everybody's looking at it. That isn't necessarily the case with FX, futures, or commodities. They can still stay below it for periods of time, which doesn't necessarily happen in the stock market unless you're in a full-blown bear market. And those are usually recovering back above the 200 within 18 months anyway. The last time we broke below the 200 for the euro currency on the daily chart was May of 2018, and we stayed below it basically through June of 2020. So we can stay below it for quite some time. However, the weekly 200, so it'd be the 200 week, that's strong. That comes in at about 115.72. So I'm actually going to move back up toward that 200 day, and I'm going to cover it well above that 200 week. I'm not waiting to get anywhere near there.
So what's the details of the trade?
So what I'm going to do is I'm going to sell a rally back to about 117.90. So figure the 118 handle. You can give or take a little bit there. And I'm going to target about 115.90, which again is 20 ticks above where the 200 is in, the 200 week is. So I'm going to be 20 ticks above that. That's where I'm going to cover that trade. My stop's going to be about 119.05. It may sound like a wide trade, but you can affect this in the micro crudes, which are now getting really liquid, and you're only doing about 150 bucks or so of risk. I don't know if you checked my math on that, but you're looking.
No, I did. And Bobby said micro crude. He means the micro euro, which is actually a pretty good and liquid contract right now. Yeah.
It is. So in the big, you're risking about 1437.50. to make 2,500, in the small, $143.50 to make 250 per contract, of course.
It's so funny because if you were going to say that you were going to buy the US dollar, I was getting ready to dig in and disagree with you. But the only thing I probably would buy the US dollar against is the euro. They're a place that has at least equal problems. And I'm not even just talking about necessarily the lockdowns, economic. I'm talking about their debt loads are awful too. I mean, ours are absolutely exploded, obviously, recently. Billy and I talked about what we see in all the commodity, and I kind of tease out crude because crude is kind of marching to its own drum. It's so economically hinged that it might trade different than platinum or things like that. Do you think there is, when I say worry about the dollar's hegemony, you mentioned that the euro is not anywhere close to replacing it. And I gave a speech back in August at the New Orleans Investment Conference, and I talked about if the chance of hyperinflation or a collapsing dollar went from 0.000% to 1%, that's an enormous and significant move, and it needs hedging. If you're someone who's got, a company or anyone's got all the money in the world, why would you not start hedging against that problem? And we've seen amazing runs now in lumber, real estate, platinum, copper, corn. Do you think my numbers are right on the potential for hyperinflation, the potential for dollar to lose its hegemony?
I do. And part of it now goes back to agreeing with Billy on the commodity super cycle, right? Just when you think about a commodity super cycle, those things tend to be about 8 to 10 years. We actually just came out of one not that long ago. And
14, right? Yeah.
Generally is about 4 years, 5 years in between them. This fits. That's a short period of time. It's generally 4 to 10 years, but this is a short period of time. And the weaker dollar would play into that. Obviously, as Billy mentioned, that's a wonderful fundamental point to keep in mind, is that all else equal, the dollar dictates whether commodities are rising or falling, all else equal, right?
Right.
So
yeah.
I think that's part of it. I think the emerging markets are going to lead in the digital assets, which will be a little bit of a threat to dollar, but it might be enough to actually do that sort of 10x, 1% weakness to the dollar's hegemony that you're talking about. So I think
I just learned that word, so I just thought I'd keep using it a bunch of times because it's a wonderful word. I had to look up what it meant, but hegemony, that's nice.
Right after the show. I don't even know if I said it.
I think you did. I think you nailed it. So real estate, the things we're seeing in real estate, and I watch Florida real estate closely. I know you do too. You're there. That's the same trade as well, right? That's just trying to get out of dollars, getting into stuff, right?
Yeah. I'm not a huge fan, honestly, of real estate investing. I know you are. And my main reason is I can do better in the stock market. I can do better in commodities, and it's liquid. But also, obviously, when you're holding on to something for 10, 15, 20 years, you can't get too much better than real estate, really. For me, it's more of a case of liquidity than anything. I just love the liquidity. I actually bought a house in California at the highs. That was ugly. And the house that I used to own in Glenview, the house in California could fit in the basement of the house that I had in Glenview. And I bought it at the highs, and it was a terrible experience. So becoming like real estate heavy is going to take a while before that's me.
I did the same thing. I mean, I talk about my failings on Twitter too. I bought a house in Colorado at the highs. I still have that house, and it's come back and done pretty well now. I want to switch over to crude oil. And again, I'm going to underscore, I don't know if you heard the impending doom nonsense, because that involves crude oil too. I mean, if economies are going to be shutting down, and it seems like they want us to, do you think, what the heck was going on with the impending doom? Do you think the trajectory of our economy is going as high as I do, or what does crude oil think? What is it telling you?
So I have two views to that. In the short term, I think the economy is going through the roof. I agree 100% on the restaurant thing. If I had a Brandt's hat, I would have it on. From a perspective of Florida, as a good example, Florida's been open since midsummer. It's part of the reason I moved down here, was to have some semblance of a normal life, and you just can't get near anywhere. I mean, revenge travel, I believe, is a real thing. I believe the summer driving season is going to be stronger than ever. I think it's going to last longer than it normally does. So I believe in all of that. The impending doom, I don't know where that's coming from. I think considering the amount of vaccines that are out there, even if the efficacy, which is the word I learned this week, is not as high as they say. Okay, say it's half of that. You're going to have if there's a fourth wave, it's going to be less devastating than this wave, even with variants.
It has to be. It has to be. I don't know what she was talking about. It's called math.
I read a lot about the messenger RNA technology in biology, and it is actually one of the benefits of this type of technology is its effect on variants, that it actually becomes much more effective with variants than your traditional vaccine. Not perfect, but better, right? So this impending doom, I don't want to get political, but it's things like that that make me think there's something else going on. And on a day-to-day basis, I don't think there's something else going on. I think we just had a pandemic. But when you see things like that, I'm like, come on, what are you guys talking about? So from that perspective, yes. Now the crude oil question, which is really what you asked me, there's going to be a spike coming in crude oil. I'm not looking for it soon because OPEC is really now the discretionary producer, right? The marginal producer is now OPEC again. That's the way we were 20 years ago. That's where we are right now until CapEx in the US increases. And with the Biden administration, we're going to find out this can be a little bit more difficult, whether you're for him or against him. That's just a fact. So I think that OPEC becomes the marginal producer. They're talking about leaving production the same in this meeting. We'll see. It's tomorrow. But from that perspective, I actually want to sell crude oil on a rally back, expecting that the next time OPEC makes a comment, not tomorrow, but the next time, it's going to be about increasing production. And we still have weakness in Europe in terms of demand. So from that perspective, and I don't love this trade, so feel free to hate it, but it's just the setup that I have. And you're going to see for me, I have a pretty tight stop. I want to sell a rally back to 60.30. And my target on that is going to be 57.30 and my stop is at 62.30. It's really simple. That's a tighter stop. My actual target for this move is in the $55 range, but I don't want to wait for it. I'm just going to cut this to a little bit too. It's a GAN level at this. My target 57.30 is actually, it's multiple GAN levels. So I'm going to take it off at a technical level. The actual target should be closer to 55.91. I'm not going to wait on that one.
So last show, we talked about something that has resonated with me, and I think about it all the time. And I want to bring it up so the people who are watching that too, because I said to Bobby, if you sell it where you want to sell it and you get a runner, is there any chance that you'll just move the stop out, take the top, take profit, bring it down, or hedge it with options? And his point to me, and I'll let you talk to it in a second, was that he likes the clear thought of looking at his trade and the levels of his trade beforehand and not let the emotion after you put it on and just let it do what you originally thought it to do. Still?
Yes, and I'm taking my notes here because I don't believe I sent it to you, but it's in here somewhere on my notes. I mentioned my actual target's 55.91, right? Mm-hmm. A clear thought process about this trade is my first target is 57.30. Now, in that vein, for you guys that are retail traders out there and you're not sure what I mean by target, all a target is a place where an action is required, okay? So if I get a runner to my first target, I've already pre-planned this on this sheet for the actual trade that I have here, okay? If I get a runner down to 57.30, I will tighten my stop and I will pull my buy order and I will look for 55.91. Let's say 56.05, because I don't like those round numbers being my problem. So that's already planned out though.
That you have that and you're planning now. That's what I like. Yeah.
So a target is a place where an action is required. 90% of the time my action is that I cover the trade. This particular instance, I might shift my risk and my target lower.
Okay, but this is now a longer term conversation about oil real quick. I was on with Larry Kudlow on his show on Saturday, and I said that I happen to like big integrated oil names. I think that they're coming back, and they have had good luck with them so far. And he's like, how can you do that? The Biden administration, again, this is not political. This is about gathering data and making a trade buy. So if anyone thinks it's political, I will argue with them till I'm blue in the face. Do you think when you hear them talking about green energy, do you think that they're going to regulate the crap out of every driller, out of every oil producer in this country? And how long do you think that's going to take to play out?
So not political. I think they will, simply because that's how they feel they're going to get reelected and keep the Congress in 2 years. The issue for me is that if you were to go full bore green energy, one of the estimates I saw is that you would still need, think about peak demand being about 98 million barrels a day to 101 for the global economy. 2035, you'll still need 65 million barrels a day for developing markets and for the process of converting. So I think it's a huge mistake to do that. If they want to get a little tighter on the environmental standards, that's fine. They think they got elected to do that, so I'm fine with that. But to just, as you put it, regulate the crap is an economic mistake. It's not a mistake for any other reason that I can speak to. It's a massive economic mistake.
And so something to underscore what Bobby just said is that, again, I'm my daughter's an environmental engineer. I'm for the environment. I'm hugely pro-environment. But if you try to affect change too quickly and dislocate markets, it has economic ramifications across the board. And there are a lot of people in government who don't understand that. So we talked about, Billy and I talked about the 10 year. 10 years moving higher. It's the rate of the change that could scare people. The same thing is going to be the deal in moving to green energy too. The rate of the change could put people out of work, could cause, a Great Depression, obviously, if they did something stupid and too quickly, right?
Jimmy, it's always the rate. I mean, the rate of speed that the roller coaster is picking up is what gives you the pit in your stomach. It's the rate of speed that the rain starts falling is what makes you think there's a hurricane or a tornado, as for the Midwest. It's always the rate. So yeah, that kind of thing, whenever you're spinning on a dime like that, the U.S. economy and the U.S. structural system is an ocean liner. It's not a speedboat. If you try to turn it like a speedboat, you'll sink it.
Right. So we talked about crude, and this is going to be the last question, and we're kind of running out of time. And crude is a commodity into itself, in my opinion, and as is gold now, which I still can't explain. When you look at the rest of the commodity complex, I have platinum, I have Bitcoin, I have real estate. What do you like the best of those things?
It's the same thing I liked on the last show that I've since lost 30% on since I liked it. I've got a small position in silver that I'm going to keep rolling.
I do too.
You do too. So you see it go down. I think when by the way, small position because I knew the risk. You mentioned on your Twitter the other day, and I love that. Leverage is a bad thing if you're over leveraged. I'm paraphrasing, of course. Leverage in itself is not a bad word. We got a small silver position. I'm going to roll it because I think when silver pops, it's going to be multiple gaps higher, not just one. So I'm willing to take the risk for a little while longer on that trade. I believe real rates right now are keeping up. They're going up with nominal rates. At some point, they likely won't. And that's when silver is really going to pop.
I agree with you. I appreciate that. I have silver and I'm planning on sucking it, sticking with it. Let's say maybe that was a Freudian slip because it has not been the greatest trade I've ever made. And I've made, silver trades 3 times a year. And the first 2 were beauties. One was one of the best trades of my career. I know we've talked about it quite a bit. Again, to reiterate before we leave, leverage got a bad rap this week. Leverage misused deserves a bad rap. Leverage that's understood and that people get and use it to their advantage and don't misuse it can be extremely powerful tool. Thank you guys so much for joining us on Futures Edge. This is a guess. This is what I like to do. I like to trade. I like to talk about trades. And, I could do this all day, but Bobby, we got to go, don't we?
Yeah, we do. We're done for today. We got another one next month. Make sure you guys sign up at the PureXposure group to get all the information.
And one last thing too, feedback, guys. Send me on my Twitter. My Twitter is at Jim Iuorio, JIMIUORIO. Send feedback, at questions. Bobby, give your Twitter too, will you?
It's Bob_Iaccino, IACCINO. And Jimmy, I want to put you on the spot right now. If we do a live online event the end of the year, you in? You speaking?
Of course.
Fun.
Absolutely. Yeah.
There's 2 of us.
All right. Thank you, guys. Appreciate it very much.
Cheers, guys.